cost can be looked at in two angles. It can be looked at as a cost, or it can be looked at as an income or a return. Now, the cost of debt is what you pay out in interest. And the other person who has lent you the money, the cost of that money is what he gets as interest from you. You know, the answer will be the same. Amena kupeleka gharama, the cost is the interest that he receives. Amena kupata gharama ya kupeleka, the cost is the interest that he pays out. The answer is the same. Okay? It can be an outlet or it can be an inflow. Because the answer will be the same, right? Now, for the company, that is, when we are looking at the cost of debt for a company, we should remember that interest that the company is paying on that loan, they can claim from the taxman as a cost to the company. They can claim as a cost to the company, so they can declare it profit. So it becomes a benefit to the company because they can claim it they can protect it from from them being told that you have more profit. Because they can now say, we don't have as much profit as you think. We are paying this much for the loan. And that man will agree and say, okay, fine.
Yeah, that's how much I can remaining debt.
Tax will now be on the remaining profit. Unlike equity capital, the taxman will not listen to you if he comes and you tell him, you know what, the funds that we're using are the investors, the shareholders' money, and we are supposed to pay dividends. Because that paying of dividends is a return for the investor, and to you, you are removing money from your company to pay the owners as their dividend. Sometimes you can remember, sometimes you can keep it instead of paying out, you can keep it because you want to expand the company. That's why when we are talking about sources of funds, and equity capital, we also talked about retained earnings, meaning my profit gaja, simunapata any ani, agora musunge, so that you can expand the company. So those are retained profits. So it's also a source of money. Remember, when we talked about equity capital, what is it composed of? It's composed of shares, composed of retained profit. Ndama zimene ene akanapeleka. Right, mwapanga profit, simufuna kuwapasa ene yake chiombora zanja, muti tisunge, so that we expand the company. So that's retained profit. You have retained it, then you're giving it out. So it becomes a source of money as well. In addition to that, but when we calculate the cost of equity capital, see, the taxman does not recognize these things. That's the difference. They don't recognize the government design. I'm only on profit market like that. You cannot say, you don't tell my dividends. My dividends, they are actually paid after war at second round or MRA. And the bad part of it, the investors get hit twice. And this should be very clear in my head. They get hit twice. Because can you imagine, this is their company. Company on the profit. MRA akutenga kuzao profit pacha. Zote company ija yukupata nijunga ni chongora sana. Chainyake company. Mukaranja chongora zanja. MRA awira kwa hiyo kuti moranja income. Tikateni so the taxman also taxes you when you receive the dividend. Dividend, mukangoranja dividend, muyo taxman amakari. So for example, mulima share ku Airtel. Kaya mulima share National Bank. National Bank is clear profit. Taxman comes and says, where is our money, made money, Mugrezo, Adena. That was a time. Because National Bank, I said, reduce my dividend. In New shareholders, my dividend. Mugaranga Yoshisha, Taxman Kujani, Moranda income, aware of Zami, or Zamia control. Actually, twice, because company is young. I used to tax on that profit. Those are other companies you get in the United company. Come United company, remember, when you make income, you are supposed to pay tax on it. Any income that you make, you are supposed to pay tax. Now, company, you remember your first assignment? Company is a legal entity. A company is like a citizen. It has rights and obligations. Just like any companies do. Companies do report. Companies do just as new money and so you have another company, and that is the way you from a company. I think so. Because it is a legal entity. You have and not so happy. That is a Galeto my shareholders in Arindarama. In Uyo, because you are also a legal entity. So you get it twice. That's what I'm talking about. Comma. The reason we say 1 minus tax there is to say, put it, the interest, if in actual say, in Uyo as a company, simply just 50,000 each time. Because when it is their own, Muma Muda was one song with the sitting about the country, 20,000. Did you select 15,000 Narita Mongoli? Interest from Mongolia as a company, United 15,000. So, in actual fact, sitting about the country, 20,000. Did you select 15,000 Narita Ugoni? And Amazon Amagonera. Hey, me calculation tax. Very different from Egypt. When you are, let's say, 100,000, interest rate out of 60,000. Okay? Then what business say, money 60,000 is about then you declare putting money profit. Okay? And that profit you can remove the minimum interest and that minimum compensation when the tax man comes. So, in actual fact, when the tax man comes, ababa manena kumkaika kumabesa kunuwiru. Okay? In actual fact, isikuti chita kupangira tax into profit challenge way. In real life, because remember, MRA comes and looks at the account. So, as I want to for cost budget, my interest paid out. Interest paid. So, at the end, you might declare 5,000 as your profit. My account management. MRA will not tell you what money. They will not tell you to remove this.
It's always how much company has to pay always when you imagine it.
Company has to declare profit for the tax man. They will take care of interest paid. And because MRA checks the yes, sir. I'm going to go to the actually, that much of that. Just go. Just in the way I'm doing it. Don't take away my beautiful girl. Yeah, for sure, I will not do that. Listen her. Okay, so MRA, I'm sure you know, would have a company. Someone a company if they were declared the profit, yeah, 20,000. And then, but you go charge. They go and look at the account. I'm a owner. And you cannot say my cost of equity as part of the cost. You must remember every man has cost. You cannot put the cost of equity minimum jam. You cannot put it in there. They will remove it and so profit will go up. Cost of debt, they will not remove it. Okay, sir? Yeah, in short. So, one thing from here, tunafuna tukabiraneza minimum onekera this financial statement. My financial statement, profit and loss measurement is a financial statement. What else is a financial statement that you know? Yeah. Balance sheet. Trial balance. Profit and loss accounts. Those are financial statements. Okay? I hope this Zama cost of equity and debt is done. So debt, for example, is a liability, right?
No.
Why do we call it a liability? It's because we have to pay back. So it's a liability. Okay? But debt is capital. That's what we have said. Eh? So you will find my account B when they are preparing my accountant, you will find these things are on both sides of the account. It is a capital, but it's also a liability. So in most company accounts you will read, there will be assets and liability. There will be assets and liability. What is an asset? Yeah. These are resources owned by a company. Okay? And resources owned by a company is in another way, what is it called? Capital. You remember we said the definition of capital is resources used for for running a business or expanding a business. So these resources are also what we call assets. Okay? So these assets can be in several forms. They can be fixed, they can be managed, they can be, they are resources. Okay? So, because of that, we want to look at, for example, financial assets. Financial assets are assets that come not in fixed form. They are financial. They are monetary. For a company to run a business, they have to have assets which are capital, and some of these can be fixed, buildings, machinery, some can be in terms of financial. Now, these financial assets are sometimes called securities. Okay? They are sometimes referred to as securities. They are called securities. Okay? Securities are financial assets or financial instruments. These financial assets or financial instruments that the company can hold are called, remember, Okay? Assets are part of capital because you use them to run a business or expand a business. Now, these financially, there are differences. There are some which are fixed, some are in form of financial. Now, these financial assets are sometimes referred to as securities. So, securities are financial assets or instruments. The main reason they are referred to as securities is when you can easily convert them into cash. Okay? Securities are financial assets that can quickly be converted into cash. Remember, for a company to run, they need resources. Some of the resources which are easily available are the resources that are in cash form. Because you need to pay, remember, you are running a company. There are daily transactions which need payment. Cash, cash is not only what you have, like bank notes. Don't be confused when we say cash. Cash can be bank balance. It can be what you have in the bank. It's also cash. So you can say cash in the bank. Or cash in your safe. Safe I am Shiroga for company. All that is cash. Now, the reason we are talking about cash is because we are referring to liquid assets. So basically, these financial assets can either be converted into liquid assets or cash. A liquid asset is an asset which can quickly be converted into cash. So securities are liquid assets. Just this is the terminology we use them as interchangeably, but what you should have in mind is that we are talking about because a company. You remember one thing that we talked about when we said what determines the structure of capital? Remember the determinant of the structure of capital structure. One of it is liquidity. Liquidity ratio or cash ratios. Remember, because if your company has liquidity ratio or cash ratio is low, you cannot go for it. That's one of it. If you go back to read what are the determinants of what capital structure you can have, one of it is the liquidity. Okay? So, why are we talking about financial assets? Why are we talking about securities? Securities are financial assets that can easily. It means now you are secure. These securities are talking about security for a company. So the securities, sometimes you read these things in publications. When you're talking about securities, basically you're talking about assets, liquid assets that can easily. They are called liquid or sometimes convertible. Sometimes people say marketable. So you find a lot of technologies. Basically, when you say you can easily convert into cash, it means that these financial assets or financial instruments, another word here is instrument. So sometimes we say financial assets or instruments. Why are we saying or instruments? It's because sometimes this comes in the form of an instrument, like a paper. What some of these assets that come in the form of a paper, if you remember? Yeah, bonds. Because the bond is just a paper. Okay? It's just a paper. You hold the paper. Or for example, certificate of deposit. You can deposit some money and you get a certificate of deposit. And you can use that as collateral something. Put it in the hand. Sometimes, for example, when you buy shares, they give you a certificate. You where will you buy shares to bank and where you buy shares in 1,000. You can get a certificate, a paper, an instrument. And that paper, you can use it to cut it and go away. Yeah. So one of the collaterals, for example, bank amafusa ulindi nyumba, ulindi mashares, ulindi jana. Ulindi deposit certificate of deposit. That tells you it's just an instrument, right? In the paper, the financial instrument, which you can trade, you can sell, or you can buy. You can buy certificate of deposit from somebody who's deposit somebody carry out. You can buy my share at so what you are saying is that these assets you can easily convert them into cash. So when a company is holding some of these financial instruments or assets, they can quickly, if for example they have a loan, they can quickly sell and give you cash. So you can debate. So a company which is holding a lot of those financial assets or instruments is considered to have securities which they can use to run business. Okay, so let us check.
Let us continue.
Sorry?
Let us continue.
So, these securities come into about 4 categories. These assets or capital, they can come in 4 categories. We have already studied 2. What are the 2 securities that we have studied? Remember, the resources. They come into 4 main types. Okay? We have already covered 2 of them. that you can quickly convert them into cash. One is equity. Equity security. Remember, securities are financial assets or instruments that can quickly be converted into cash. That's the definition of security. Now, we already know two types of resources, of assets, of financial instruments. One is equity securities. Share, can buy and sell, easily get cash for it. If you have a certificate which talks about you having shares, you can easily go and get money back. You can even sell to somebody and you get the cash instead of holding that paper. Okay? Yeah. So equity securities. What else? Debt security. One of the examples of debt is a bond, for example. And the bond, as you know, is just a paper which states that we have borrowed your money and we'll pay back on this debt and we'll pay your interest every 6 months, and at the end of 24 months we will pay the principal, which is different from a loan, where you pay monthly interest and principal, whereas the bond you only pay interest and then at the end you pay the principal, all of it at once. So you have equity securities as well as debt security. What else is different? There are other two types of security apart from debt and equity. And these are what we call derivative securities and hybrid securities. So derivative securities and hybrid. That's the only addition we can add to these assets. So we have four types of securities: equity securities, debt securities, derivative securities, and hybrid securities. Okay. Derivatives come into several forms. These are financial instruments where the value is dependent on a number of things. So these are financial instruments or financial assets whose value depends on a number of things. Okay? One is interest rate. Secondly, market indices. So, what are we saying, for example? These derivatives are financial instruments that take into account a number of things. So, for example, you make an agreement, for example, that I will deliver something to you at a later date, for example. this quantity. So you have a contract. This contract becomes something that you can sell. You can buy or sell this contract that you have made. So for example, they come in various forms, these derivatives. You have what we call futures. You have futures. You have forward. We have what we call options. Dropped my phone. Huh? And then we have what we call swaps. Huh? These are types of these are the types of derivatives. Okay? Types of derivatives. Securities. So for example, futures. This is about it's a contract. They are futures contracts, for example. The example that I just gave. When you ask what are the derivatives. Derivatives are financial assets, but they are dependent on a number of variables. One of them is market conditions, for example, I said, the rate of interest and blah 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 blah. So the idea is to secure something.
So in short, derivatives are financial assets that depend on
A number of variables. Okay? They depend, whose value depends on a number of variables. Okay?
financial assets.
Yes, they are financial assets or financial instruments.
That
Depend on some basic variables such as interest rate, market conditions, the type of goods, for example, so one example is what we call futures or futures contracts. Now, futures contracts are usually an agreement between two parties.
Yes.
Okay? So this agreement is like you say, okay, I will purchase your maize next year. I will purchase 10,000 metric tons of your maize next year at this price. And then you agree to say, okay, I will grow and supply maize to you. So you and me make an agreement. So it's an agreement between two parties. These things called futures. Okay? So you agree to purchase or deliver an asset. You agree to purchase or deliver an asset at an agreed upon price. In future date. So you can sell this agreement. So for example, I have an agreement. For example, you are a company. I have an agreement with you to supply you maize next year, 10,000 tons at let's say 40,000 for a bag or 50 kg. Sign a contract teacher. Now, this supply because of that contract in Zambia. Okay? So these are futures. You can trade the they are traders. You can convert them with cash. Okay? And it has binding. It is binding. You must fulfill the contract. Otherwise, the other person can take you to court. These are binding agreements. You must supply and I must buy. Okay? So that's the future. Then you have the other one which is called forward. So you have futures and then the other one is called forward. These forwards are forward contracts, very similar to futures contracts. Forwards are forward contracts, very similar to futures contracts, but you cannot trade them. You cannot just go on the market and buy and sell them. So they are different from futures. Because futures, there is a binding agreement in them, so they are more secure. These securities are, forward. You cannot trade them.
So,
Yeah, they just sleep. Just sleep. So the forward contract, the buyer and seller, they agree on the terms, the amount, how to settle, for example. It's not like standardized contracts which you find in futures contracts. Futures contracts are more standardized. They are standard. When you say futures contract, it's the same whether it is between you and me or you and another person. The contract will have the same kind of standard. The forward, you determine, the buyer and seller will agree on how it should look like. Now, the forwards are also listed because you cannot trade them. They are listed because you cannot trade them. You cannot buy and sell them. So it's between you and the other person. Now, this is that if somebody else, for example, if you are the company that wanted to buy my name, and then you become bankrupt, and you have already started growing the name, that agreement cannot be sold, unlike in the future. Futures you can sell at the market. So now, because I cannot sell, and you as my partner has become bankrupt, I have a problem. So I have to negotiate maybe an agreement with somebody else. I cannot just sell the agreement that we had between you and me. So you can have a loss. Meaning your bargaining power will be lost. Because you have to go and negotiate with somebody else. So you actually empower. When you are negotiating because you are desperate, it's different when you are negotiating when you are not desperate. Now you are desperate because the other partner has become bankrupt. There's nothing you can do. You just have to find somebody else. So I just wanted to finish explaining this. Options. Options are also similar to contracts. It also involves buying and selling of an asset. Options are similar to futures because they also involve buying and selling. So in the case that I had, that I gave about me selling the maize to you, you buying the maize from me. So they also involve two parties buying and selling. And it's also about determining the date and the price that you supply, for example, or buy. The only difference with the future options, you have an option to fulfill the transaction or not. There is an option to fulfill the transaction or not. The buyer may not be required to complete the action of buying, for example, or the seller. It's not a must that they must fulfill. So nobody can take the other person to court. You have an option to get out. To buy or sell, or the seller may not also. No party in the agreement is bound to fulfill. Okay? Yeah. So there are options for you to move up. That's why there are some options. And then you also have what they call swaps. These swaps is these agreements are where you can swap. You can swap one kind of cash flow to another. You can swap some of the details in the contract. So for example, you can, if I take a loan and a swap, initially we can agree that I will pay interest on a fixed date. You can swap it for to be paid every month. Rather than just say I'll pay Caterpillar niligira pakata pamwezi principal plus interest. You can change it to put interest in Libya every day. You can swap the conditions. Maybe I've given a bad example, but that's meaning that you can swap one condition for another. So you can swap the agreement from, you can vary it, so to speak. So you can switch, for example, or you can vary. For interest rates, you can vary, for example, from fixed interest rates to variable interest. Now, hybrid securities or financial assets, as the name suggests. Remember, we had debt securities, equity securities. Hybrids are those securities that combine both debt and equity. A hybrid is a hybrid of debt and equity. So the hybrid security, as the name implies, has characteristics of both debt and equity. So hybrid securities have characteristics of both debt and equity securities. So, what examples do you have? Convertible bonds. Remember we talked about bonds that you can convert. Like, a bond is a debt. So a company can get this, can go into this debt, and they go into debt, and instead of waiting around, they say, people will sell my share. So means debt is just a share of the company. It means the debt has been converted into equity. It's all. So, convertible bonds, for example, debentures, they are part of what we call hybrid securities. You can trade them. Remember, securities are the ones which you can quickly convert, meaning you can trade. You can quickly convert into cash, meaning it means you can trade. That's what we mean. Palitika. Woti ukangofuna lero la soda ndikulisa inchi. You get money. Hybrids are those which you can sell them, but they have a characteristic of both a debt and equity. That's why they are called hybrids. So we have debt securities, equity securities, derivative securities, hybrid securities. And what are securities? Financial instruments or assets that can quickly be converted into cash. Sometimes this part of as liquid assets. Any questions? I wanted to ask you when you can have what we were doing, which is cost outline in the area. But in Zambia, and we have only about 6 weeks to go. Chikumana maybe 6 or 5 times for the end of 7. There is major cost outline in Zambia. For Jordan, Pelen Madwara, without any makeup. Just very sorry about a lot of these issues. I know it's very difficult. I don't know why. Makasi now is matter for easily getting people to agree with the humanity product. Makasi now is matter for can we meet can you say what about this 10? Is that okay?
Yeah,
yeah, okay. So we meet this 10. Maybe we can catch up. What is the Sunday?
No.
Good. Thank you very much
You
for your understanding.
yes.
Approved by Friday. They are not give you before system physical and so the other thing you should know is there's no dinner. Senate matter of Musitamana kapenda kumwekea. Yes.